On Monday, October 21st, fewer than 20% of the S&P 500's holdings advanced on the day, yet the index itself was just barely negative. So the question is this a sign of greater weakness or just an aberration within a long-term uptrend? We're going to find out today. So if you were paying close attention to the market on Monday, it may not have been evident just how bad the internals were. And one of the major reasons for that, of course, is that the NVIDIA was making new all-time highs, and that's where all the focus was. But if we look closely, we can tell that it was not only a bad day, it was the worst breadth session in 6 weeks, going back to September 6th. And so looking back just over the last few months, there have been a few big down days in terms of internals for the S&P 500. Again, just a few days ago, on the 21st, there were 16% stocks advancing, and that matched what we saw on September 6th, which also had 16. And before that, we have to go all the way back to August 5th, and we all remember that day, only 4% of the index was higher. Now, we know that the S&P finished a good deal off the lows, but still was down 3%, which was by far the biggest decline we've seen in 2024. Now, on September 6th, it was also a pretty nasty decline overall. S&P was down 1.6%, and that makes the most recent decline of just about 20 basis points really stand out. Now, again, this is because of NVIDIA and a few other of the larger cap names doing better, but any time that occurs, there's always a question of where's the foundation coming from? Now, we reviewed this in the past, and we know that overall, the foundation's been fine, because on days like this, when technology, or at least one or two stocks, it leads, you tend to have the rest of the market do relatively okay. Now, the question, of course, or when it becomes more of a concern, is if something like this continues. Now, we saw that on the way up in June into July, things got very top heavy, and eventually the market needed to pull back. But let's take a closer look at this, because this is only about 3 months worth of action here. And so looking at all of the sub 20% breadth days since the October 23 lows gives us a better indication of what we could possibly expect going forward. And so here are all of these in table form ranked by the worst internals we've seen, again, going back to almost a year now. And we can see a few of them were less than 10%. If you go back down to the most current one, again, this week, 16% of the S&P 500 advanced. And again, only a 20 basis point decline, which was actually the second best performing day of this entire run. We have to go back to December 5th of last year, when the S&P was down just 10 basis points. And we don't even have to look back at that and to understand what was most likely leading that day as well, large cap growth. And so let's look at this on the chart. As we can see here, a few things stand out we should look more closely into. Okay, number one, there have been clusters just twice here. And we can see that on the way up, we had 3 days within about 3-week period when the market had fewer than 20% of its stocks advance. And so that, of course, was in the middle of an uptrend. Now we have to go all the way to April, the first time that we saw more than that. There were 5 different days from the beginning of April to the end of April. And that occurred, of course, at the time, the biggest drawdown last October. S&P, as we remember, was down 6%. And so really, this was the first time that buying a dip with the market, say, down between 1% and 2% from its highs did not work. So once that wasn't the case, once buyers weren't immediately rewarded, that's when we saw more of these kick in. Now, ultimately, that, of course, didn't lead to too much downside action, but it was a slippery slope there for a few weeks. Now, the most surprising part from our perspective is that during this entire pullback from July 16th all the way to August 5th, we know down 10% in about 3 weeks, only one time do we have a session that had breadth with less than 20% of the S&P 500 stocks advance on August 5th. Trust me, I triple checked this, so we track it every day, went back to confirm as well. And if you recall, one of the major reasons for that was on the reverse, the pullback from the July 16th high was led by large cap growth. And so the rest of the market did relatively okay. Even on those first 2 trading days of August, we still didn't get a really deep market internals reading on the negative side until August 5th. And remember, down 3%, but off the lows. And so even though many stocks finished a good deal off their lows, hardly any were able to make it back onto the positive side that day. And so, as we know, right after that, we had the 8-day rally, which took us to basically back to the July 16th high there. Now, these also occurred near major trading lows. Going back to October 27th last year, remember that was the last day of the pullback. Little do we know at that time, but it went through that weekend. On October 30th, the first 1% gain of many started, and we started to get all those breath thrusts. And here we are a year later. We also saw it back here just a few days after the April 19th low. On April 30th, there was just another mini pullback that was confirmed higher low. Market continued higher from there. We just talked about August 5th. And don't forget, September 6th as well. Started that month, 4 straight declines, and it looked like that the lows of August were potentially going to be revisited once again. When that didn't happen, we had that big down day with a lot of stocks, again, for the S&P 500 moving lower in unison. When that did not lead to additional weakness, then the slingshot was on once more. And then lastly, there are times when this occurred when the market was making new highs and continued higher. And so going back to that January, February period when we had 3 of them, as we can tell here, this period did not look any different really from the previous few months that were trending higher, and then the month and a half or so of trading that continued along the way, even with the first real indication of breadth potentially not being, as extreme to the upside anymore. And we can make the case that even in the middle or the beginning of December, the December 5th date, the market continued higher, but it did lead to about, say 4 to 5 weeks of back and forth movement. And so, as you recall, at from the end of 2023, the beginning of 2024, there was a good amount of weakness, especially in large cap growth, but we know that ended up being a short-term respite as well. And so we can also look at breadth from various perspectives, and here's one of them which I thought was extremely insightful. And so this is from Seth Golden. Many of you know him from X, does fantastic work, and he shares a lot of cool studies that he runs himself and also comes across. And he shared this one a few days ago comparing 2024, saying that 2013 had a stronger bull market tail with stocks trading above their 200-day moving average greater than 74% the entire year. But no year, Seth continues, in the post-Great Financial Crisis era has had a triple 70 average like 2024, talking about 70% of stocks trading above their 20, 50, and 200-day moving averages. And here that is in 2024. So we can look at this more closely and look at all of them above the 200-day moving averages, 50 and 20. You can see the difference, the oscillations back and forth, dealing with those bear market rallies. And even in 2023, factoring in that correction from August to October, and it wasn't until after that time when 2024 really began when things became more consistent. And you think about how that has helped stocks have pulled back. They've done so above a rising long-term line, which shows that many stocks continue to be in a long-term uptrend from that perspective. One of the best case scenarios you can have is having any stock or index trading above a rising 200-day moving average. Clearly, that's the definition, not only an uptrend, a long-term uptrend, because a lot has to occur, especially coming back from a bear market, for that to stay in play. Now, regarding the short term, we talked about how the last few pullbacks have taken the 14-period RSI and the 2-hour chart back down to oversold territory. Not much needs to go on for that to occur. Yes, this 10% decline did it twice along the way, but even these smaller pullbacks from the April lows did it as well. And so we were anticipating potentially that happening again, coming off that late August rally into the September pullback. That occurred, but it hasn't happened again since. And that's important because we pushed above new highs We're getting into October. Everyone anticipated volatility to spike once more, and it really hasn't happened yet, to the point where the greatest pullback or drawdown we've had since those September lows has only been about 1.6%. And that kept that short-term RSI right above the mid-range, and it's happening again right now. So can we continue to see really marginal pullbacks along the way, even as we get now into the thick of earnings, and now we're 2 weeks away from the presidential election? The answer has always been no, of course, the whole way, but so far it continued to have happened. So let's look at the bullish patterns now, which of course is the crux of our analysis all the time, and the breakout zone from 5650 continues to hold. These are the two patterns that we've been tracking ever since we got that trigger back then, and as the market continues higher, the best thing about that, of course, is that it creates a bigger cushion every time we see an upswing. And so we can't ignore the fact that a greater pullback will potentially happen at any point, right? The biggest stocks and companies haven't even reported yet. So if we do get a bigger pullback and drop down back to this zone, it will be a drawdown of nearly 4% from the most recent high. Doesn't sound like a lot, but again, if we go back to that other chart here, it will kind of line up to the pullback that we had from the end of August, early September. And that was, again, strong enough to get this back to oversold. So the best case scenario going forward, from our perspective, is to continue to see bullish patterns work, meaning that we see them constructed, we see the breakouts, and just as important, the pullbacks after those breakouts do not violate the breakout zone. So a pullback from here of, say, between 3.5 and 4% would not wreck any patterns. Anything more than that, we'll have to see how the market looks and go from there. That's it for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.